Okay. Hello, everyone. Good evening. I'll just wait for a minute or so. I think there might be a few more people joining in. So we'll just wait for about a minute and then we'll start. Okay. So welcome everyone to this June AMA webinar. This is the agenda for today. I'll quickly tell you about ST and Gulaq, and then I'll share the rebalance update for June, and then the breakdown of returns. And there have been few questions that have been asked by our investors and potential investors. I'll take up those. Okay. So quickly about our firm, ST. ST is a pioneer in systematic investing in India. It's been in business, in the same business for about 15 years. Earlier, we have developed these kind of institutional grade advisory and trading capabilities, and we were actually servicing a lot of institutions and HNIs. And through this brand of Gulaq, we want to use the same skill set, the same technology and the skills that we have developed under ST to offer quant-based portfolios for retail investors. So till now, we have served almost more than 20,000 subscribers, and it was launched in 2020. And again, I'll also talk a bit about the multi-factor methodology we are using. This is the core team, Sandeep, who is the founder and CEO of ST Advisors. He did his BTech from IIT Delhi and MBA from Columbia, has 30 plus years of experience. I also did my engineering from IIT Kharagpur, and then I have around 20 years of experience in trading and investment management. And then we have Isha, who is from ISB, and yeah, she has about 6 plus years of experience in consulting, research, and financial services. These are the usual disclaimers. Okay, so this is the change from May to June. Now our large cap is primarily about 31% and we are 69% in mid cap. And in June portfolio, we have 0% allocation to small cap. Now you can see the changes, the trend. The trend has been that since January onwards, we have been increasing our allocation in large caps, and small cap has actually gone down to zero, and slight increase in the mid cap allocation as well. So that's been the change since last couple of months. Again, sectoral allocation, we tend to remain bullish in healthcare, in consumer staples, in energy, and uh, and IT, financials, which are some of the big sectors, and even materials. Here we are underweight. Okay. Now, quickly taking you to the gear-based methodology. See, in gears, what we do is we believe that every investor should be investing according to his or her risk appetite. Okay. And that is why we have created these gear-based portfolios in which gear 6 and gear 5 are meant for aggressive investors, which gear 5 has 80% equity and 20% debt. So gear 5 is slightly less aggressive than gear 6. And then we have gear 4, which is 60% equity, 40% debt. Ideally, if you do not know how to get started, which portfolio to choose, I think gear 4 is a pretty solid choice. And then gear 3, which is even more conservative, in which we have 40% equity and 60% debt, right? And I think on days like today, uh, I would like to highlight that Gear 6 is not really meant for all the investors, for every investor, because obviously the returns in Gear 6 would be highest because it has 100% equity, but so would be the volatility in this kind of portfolio. Now, these are the returns over last different time frames. Since inception, we have almost done double of the benchmark multi-cap index. So since May 2020, benchmark has given about 25% annualized returns, and we have been able to do about 53% annualized returns in this. Now, again, the thing to consider is this does not include the cost of rebalance, which is your brokerage cost, transaction cost, and slippages. So the actual returns would not be 53 depending on the brokerage and depending on the size of the portfolio, it will be lesser than 53. But still, there is a decent alpha between we have been able to produce. Right? Now, these are the returns of Gear 5 as compared to the benchmark multi-cap index. Now, in this specific benchmark, what we have taken is this benchmark is a custom benchmark in which 80% of it is equities and 20% is FD, because that's how you should compare that to Gulaq Gear 5, which has 80% equity and 20% debt. And if you see, even in this, the alpha generated over the last 4 years or so has been quite significant. Now, Gulaq Gear 4, again, we launched this about a year, 1.5 years back. And in this also, you can see this performance. Again, in all of these portfolios, the equity part remains the same. It is exactly same in all of these portfolios. The only difference is what is the percentage of your overall portfolio that is allocated to equities. That's the only thing that differs. Otherwise, the number of stocks and what we have allocated, that remains the same. Now, this being the most conservative Gulaq Gear 3, which has 40% equity and 20% debt. And even in this, we have given a pretty solid returns over last 4 years. Obviously, market has helped in all of this, but you can see all of our portfolios have done considerably well then as compared to the benchmark indices. This is since beginning. So 100 rupees invested in the Nifty multi-cap 500 index would be 279, whereas the same amount would be 659 in case of Gulaq Gear 6. I've also shown here the year-wise returns. So this year, uh, Gulaq Gear 6 has given about 14% in last 5 months. This is as of 31st May versus 9% for in multi-cap index, the benchmark index. Yeah. So about 5% alpha, and a lot of time people ask us, what is our expectation? What is my expectation from Gulaq Gear 6? And I think uh, we are on track this year also. What I always say is my expectation is that we should be able to do somewhere around maybe 8 to 12% alpha over the benchmark. And in last 5 months, we have created about 5% alpha. So we are almost um, on track to do that. Obviously, previous few years have been good. And this year, we'll see what happens. There's still 7 months left, but there's still some alpha that we have been able to produce in last 5 months. Now, we also keep publishing blogs to educate our investors, not only uh, on investment, but in personal finance also. And these are the three blogs that we have published in last month. I would encourage everyone to check out. One is about mutual fund categories deep dive. One is related to our performance in the PMS fund. And second is the factor investing in general, how that has performed over last 1 year or so. So yeah. So you can go to gulaq.com and check out the blog section. And these are the blogs that we have published in last 1 month. So now I'll start with Q&A. We have received quite a few questions and we have included this in our Q&A, and I would first answer that. And after that, I'll take up any questions that you might have currently. I'm also seeing there are few questions on YouTube. So I'll try to answer as much as possible. Okay. So one question, Sharad asked, what are the returns of Gulaq Gear 6 last 5 months returns? So Sharad, I've already shared this year. We have done about 14%. Yeah, we have done about 14% versus 9% in Gulaq. in BSE 500 index. Second is Neetu Agarwal has said, I'm planning to invest 10 lakhs in Gulaq Gear 6 and would like to set up a systematic withdrawal plan of 20,000. Will my capital deteriorate over a period of 1 to 2 years, or will my initial investment of 10 lakhs remain intact, assuming an annualized return of 24%? Okay, so if you are able to make that 24% annualized return, that is 2.4 lakhs, and you'll be able to withdraw 20,000. That sounds like a good plan, but Neetu, in reality, I think 24% expectation is a bit too high. We might do, if the overall markets are also good, we might do even more than that. In some of the years we have even done double of this, but over long run, to expect 24% returns every year is quite tough, right? So I don't know why you want to withdraw this 20,000. If it is for some very, it is need based and it is something for something important, then I don't think you should rely on this plan. You should not rely on markets to give you 24% returns every year. That's not how it will work. So it's kind of a risky plan. The chances of success is low. As I said, ki withdrawing it every year is a tough, because some year, if the markets are down and you withdraw also, then your portfolio would be hit badly. And if the markets give you, let's say 40-50%, then you can easily withdraw those years. But to do it on a very, very systematic basis, it's kind of tough. Yeah. You should not rely on such a plan. What is the benefit of investing in PMS? Okay, PMS related questions. I think there would be few more. Okay, let me take it right now. In fact, so benefit of investing in PMS is, first of all, these two, Gulaq Gear 6 and PMS, they are essentially created using the same methodology. So it's the multi-factor method in which we combine everything from technicals to fundamentals to macro factors, and then we create these portfolios. So the methodology remains the same. The difference is in terms of diversification. Because PMS starts with 50 lakhs, we are able to offer much higher diversification. In PMS, we have about 80 stocks, and the performance is still pretty solid. Whereas in Gulaq Gear 6, we have 12 to 15. So obviously, any portfolio, if you compare these two portfolios, Gulaq Gear 6 is going to be more volatile than PMS. Uh, but the advantage in Gulaq Gear 6 is you are able to start small. In PMS, you can only start with minimum 50 lakhs. One of the difference is, in PMS, we will take care of the execution. So in ST, because we have that high frequency infrastructure in place, we are able to execute your orders at a very efficiently. So the slippages that you see while rebalancing, that comes down considerably. So that is, I think, one of the biggest advantages. And Aman, I would encourage you to go to gulaq.com. There's a section of PMS. You can check out more details there, and it has our contact details also. So if you want to talk to us regarding this, you can just leave your details and we'll be happy to call you back. Okay, rebalancing. Now, why have we done rebalancing a day prior to exit poll? So yes, so we do not really take this into account when are the exit polls really, and because it's very hard to predict what would happen in these exit polls, right? So everyone is surprised by the move today. What has happened today? Till yesterday, everyone was very optimistic, and you saw the markets were up. And today it is a totally opposite move, totally opposite mood. So it's very difficult uh, to predict what is going to happen in exit poll and on the election day, right? So you should not base your long-term investing decisions on the basis of such events. Now, this is obviously a very big event. It's not how we create these portfolios or how we manage money. Our expertise is in data-driven uh, methodology. And what we are saying is, see, whatever happens, everything is going to be priced it into stocks within a month. And next month, when we rebalance, then everything would be taken care of, right? So it's about a month. Now, Some might say that a month is bit too long to rebalance. And there are others who say, why are we rebalancing on a monthly basis? It should be quarterly or even less frequently, right? So they are all sorts of opinions. But what we have done is we have taken historical data and we have tested our algorithms, how best we can offer our advice. And what we have seen is the best way, the best portfolios, the best way to create and rebalance portfolios is on a fixed frequency basis, which is monthly. And that is what we are following. You really don't want us to be meddling in portfolio construction, in changing that, because that is not we are experts at, right? Uh, yeah, so that's what I have to say for that. What are the reasons for exiting from PSU stocks? Again, this is purely on the basis of fundamentals and technicals combined, right? So that's why we have exited. I think till now, today PSU stocks have fallen considerably, maybe somewhere between 10 to 20% also. So there are few investors who are happy that they got exited from PSU stocks. But till yesterday, there were few investors who were asking why we have removed them, because yesterday PSU stocks were the ones who rallied the most. But if you see net, see in these 2 days, nothing really much has happened. If you see the markets, yesterday they went up, today they came down. So there's maybe a difference of about 3% or so in these 2 days. And really, it's not a big difference overall what has happened in last 2 days. And we should really remain away from this is mostly noise in the market. We should really not make any decisions during these kind of volatile days. Most of the time, I've seen many investors, they end up making really bad decisions just on the basis of 1 or 2 days. That's not how investing should work, right? We did exit. Why did we exit from Indus Tower when telecom is displaying good growth? Again, Radhakant, we normally do not comment on stock specific uh, actions. And this is all on the basis of the algorithms that we have developed. And we do keep a track of what the algorithm is doing, how we can improve it. That's what our research team is doing all the time. But at the time of portfolio construction, we do not question why it is being done and whether that is the right decision or not. That's not what we do. But we do take into account what is happening, how is the performance been for each stock, each sector, and how we can improve it, right? But we'll never touch our algorithms and the output in real time. When we go back, we'll take feedback from all of this, and we'll definitely keep on improving our algorithms to do better. Okay, I've subscribed to Gulaq Gear 6 small case yesterday and initially invested 21,000, which was allocated to 12 stocks. When I clicked on invest more and added 5,000, it only invested in 5 stocks. Is this intentional? My understanding was that 5,000 would be spread across 12 stocks. Could you please clarify? Sukumar. So yeah, Sukumar, the way it works is to invest in all of these 12 stocks, what you need is about 20,000, and we have kept a buffer of 4-5,000. So overall, what you'll need is 24,000. So whenever you invest 24,000, then you'll be allocated all the 12 stocks. But if the money is lower, then we have written our algorithm so that the way it will do is it will try to get you allocation to as many stocks as possible. But obviously with smaller amount, we will not be able to do that in the right proportion. But when you actually rebalance it next month, now overall what you will have is 21,000 plus 5,000, that is 26,000. And it will take into account the 26,000 portfolio and rebalance it exactly the way we have suggested. So for this specific month, what is going to happen is this 5,000 rupees worth of stocks is going to have some model error. Now, what we mean by model error is it's not going to behave exactly like the model that we have suggested, which means there could be positive error or negative error, which means it could be slightly, it could have slightly better than the model returns or even worse. So that is random in nature, but that error is going to be there. But from next month onwards, it's going to exactly mirror the portfolio that we have suggested. And that's the way it works. Okay. Why doesn't small case automatically execute rebalancing? Because by regulations, it is not allowed, Chandan. uh, anyone apart from you, not your broker, neither small case nor your advisor, can actually place orders on your behalf. So what is happening is we are advising. That advice is uh, reaching you through the platform of small case, and then you are the one who are sending those orders. When you click rebalance or when you click invest more, you are the ones who are taking that call of sending that order to your broker and then to exchange. So by regulation, nobody else can actually intervene in this and place orders on your behalf. And that's why I said in PMS what happens is those regulations don't apply, and in PMS, your PMS manager is allowed to execute on your behalf, but not in these in this kind of structure. That is not allowed at all. So this is by regulation. Nobody can do anything on this. Okay, methodology. What is the impact of frequent rebalancing on taxation? Rohak has asked. So Rohak, the way it will work is almost all our profits would come under short-term capital gains tax, and you'll need to pay those short-term capital gains tax, which is 15%, right? So that 15% of profits is something that you'll need to deduct. So what we'll do is next time maybe we'll share the exact calculations also. So let's say if we have been able to create alpha of 15%, now on that 15, let's take it 10%. So over the year, if the alpha generated is 10%, so on 1 lakh, we have given a profit of 10,000. Then on 10,000, you'll need to pay 15%, which is 1,500 of short-term capital gains tax. That's how it'll work. In reality, last 4 5 years, we have given much higher returns, that even if you account for these short-term capital gains tax, we are still much ahead of the benchmarks. So yeah, that's how it will work. Mid-cap index PE is considerably higher than long-term average. How do you see overall market valuations at this point of time? Again, I think they have already corrected today. But see, the way we see is we take into account fundamentals and technicals. So a stock, technicals like momentum. So a stock which is in momentum, which is doing well fundamentally, it's very, very hard for you to get such a stock at low PE. They'll always be expensive. Something like let's say Microsoft or Amazon, these stocks which are growing at a much faster pace than the overall industry, they'll always be available to you at expensive valuations. Now you can keep on waiting for them to correct, which actually might not happen, and you might waste years, or you buy into that expensive valuations because the market is ready to pay those expensive valuations because it considers that these companies will keep on growing for a longer period of time at much higher rate than the average rate, right? And that is why they are expensive. And even in India, some of the best stocks like Titan, Asian Paints, HDFC Bank, when they were growing, HDFC Bank right now is not really doing too much, but in their heydays, they were actually always much more expensive than the market valuations, right? So we should not really, that is one way of investing. Another way is you just focus on value stocks where the stocks that you want to buy are always trading lower than the market PE, which are very, very undervalued. And and to invest in that requires totally different mindset and totally different level of patience also, right? Because the market might reward this on a very, very long-term basis. For a few years, it might not do anything at all, those undervalued stocks, right? So that is different than the way we are constructing our portfolios. But having said that, I again want to emphasize here that we do take into account the fundamentals along with technicals, and then only we decide which stocks to invest in. Okay. Are commodity ETFs included in Gulaq Gear 6? No, only the single stocks are included and no ETFs are included in our universe. Okay. What does quant investing really mean? Anand had asked, and what is factor investing? Pranjal. So, one thing, tomorrow we are doing a deep dive into factor investing or quant investing. This is one and the same thing only, and we are doing this along with Upstox. So if you are interested in learning more about it, this webinar would be conducted tomorrow from 7 p.m. And the details, all those who are our investors, subscribers, we'll be sending an email, but you can also check out our pages on Instagram and LinkedIn, and we'll be sharing these details with you on our social media handles. But for now, quant investing is, in very simple terms, it is rule-based investing. So what we do is we create rules as to if A, B, C happens, then we'll buy. And if D, E, F happens, then we'll sell. So it's in very simple terms, that's what it is. The way we are doing it is we study hundreds of factors. Now, what is factor? Factor is anything that impacts a stock or a sector's price is a factor. Like, let us say oil prices. Now, oil prices is a very important factor for airlines. Why? Because if the oil prices are higher, then airlines, because they're running obviously on fuel, um, that is the input in that. So their expenses are going to go up, right? So it works like a high oil prices works like a negative factor for the whole of airlines, right? Another factor could be inflation. So inflation might impact few companies in a negative way and few companies in a positive way. Another factor could be GDP growth rate. Now, these are macro factors, and then there are micro factors also. There are factors like how a company's PEs or price to book, or how a company's earnings are growing, at what pace are they growing, and how consistently they are growing. Now, these are all factors. Now, what we do is we study almost 100 factors that can impact their prices. But having said that, not all 100 factors are important at any point of time. So in a rising market, there will be few factors that will impact stock prices much more than the other factors. But if the markets are in bear territory, then there'll be another set of factors that are more important than all the others, right? So primarily what we want to be doing is, in a rising market, we want to be aggressively placed. Whereas if the markets are sideways or negative, then we want to be conservative in our approach. So we figure out what are the kind of markets we are in. Then second step, what are the factors that are likely to work best in this market? And using that factor in a very, very systematic rule-based approach, we will rank all the stocks based on those selected factors, and then only select those specific stocks which have a consolidated high score, right? So for it to get selected, the consolidated score between technicals, fundamentals, and macro factors has to be the highest. Only then it will get selected. Yeah. So that's what quant investing in very simplistic terms is. If you want to know more, I'll encourage you to join the webinar tomorrow, which is scheduled for 7 p.m. Okay. Investment and market guidance. Which is better, mutual fund or direct equity investments? I think direct equity investments, Sachin, if you're doing it on your own, uh, I know very few investors who are able to do it well. Most of the investors, if they pick stocks on their own, don't really do a good job of it, right? So if you just compare picking stocks on your own versus mutual funds, clearly mutual funds are better. Now, if you consider mutual funds versus something like what we are doing, where we are advising you, again, there's no clear answer. What I would say is there are few small cases which offer very unique kind of product. And if you are able to identify those, then add that along with the mutual funds. So they are definitely, these small cases are not a replacement for your mutual funds, but this could be added along with mutual funds, right? Only if they are able to offer, again, the focus has to be, you have to see the manager, how experienced they are, how good a historical performance they have, and how much focus they have on research also, right? Because on last few years, it's been relatively easy to produce alpha, and that has helped us also. So you should do a deep dive into what the investing philosophy is of that manager, and that is something that you should do for mutual funds also. The investing for philosophy, how well you are actually uh, following that investing philosophy. Is that uh, the manager is saying something else but doing something else? Again, even if they are able to produce returns, it's not the right thing to do, because then you are digressing on what you actually, your mandate is as a manager. So do that study. But if you want to know whether you should learn and pick direct equity investments on your own, I would actually not encourage you to do that. It's a very, very hard thing, time consuming thing, um, not the best use of your time, frankly. What is the right time to invest, Deepak? Uh, Deepak, the right time to invest is, I'm assuming you would be in a regular full-time job where you'll be getting your salaries at the start of every month. And I think that is the best time. So whenever you have money, for your long-term investments, that is the best time to invest. Really, don't try to time the market. Don't try to see if it is the good or bad time to invest, because usually, again, it's very hard to predict that. What can be said with a good amount of certainty is, over long term, markets would rise, irrespective of what is happening in these next few days. Over the next 5 or 10 years, India growth story remains intact, and equity markets would be the best place to be invested in over long term. So invest in a systematic way, and don't focus too much on market valuations, whether it's the right valuation to invest or not. Yeah, that's what I would say. Okay, Amit has written, until last year, I relied on YouTube stock tips. But since switching to Gulaq and small cases, I have found investing much easier. However, I am concerned that by not analyzing financial metrics like before, I might miss out on learning and understanding the market. How should I educate myself further? I think, Amit, this is an excellent question. Uh, and what you're doing is also right. As I just told you earlier, one should not get into direct equity investments. And if you see most of the YouTube channels or these business channels, most of them, they just discuss a specific stock or a sector. That if BJP comes, which is the stock that you should invest in? If not, how should your investing be? So all of this is, I think, noise. One should really not get into. It's meant much more for professional investors, not for retail investors. I think the best use of your time is into your jobs and your career. If you, that will yield the best returns for you, right? But at the same time, what I'm saying is, I'm not saying do not look at markets or do not try to educate yourself, but try to educate yourself on the right things, not on learning technical analysis, not on learning how to read a financial statement. Really, that is not how investing should be practiced by most of the investors. I think one of the most important thing that almost all investors neglect is learning about market psychology or your own behavior, right? How, so maybe learn and read about the financial history, what has happened in the past, what happened in crisis like 2000, the IT boom and bust happened, what happened in 2008, how investors reacted, and what are the common mistakes. So mostly, I think it's about yourself. Understand yourself, understand what are the common mistakes people make. Again, not in picking stocks, but in overall managing your investments. Now, this is the perfect time. I think right now, what are the kind of common mistakes people might be making, or what are the common mistakes I am most likely to make in this kind of a scenario? Today, markets corrected. Many investors might have just exited fearing the overall volatility in the market, whereas some others might have picked stocks at very, very good valuations also. So just think about all of these things. How so for everyone, the game is different. Some are playing very short-term game, some are playing longer-term game. You need to understand yourself and figure out what is the game you are playing. For me, one thing, obviously, I'm a very, very aggressive investor. But at the same time, for me, what matters most is whether by that specific investing in that specific asset class, am I able to sleep well at night? I think that is one of the biggest factors for me. So I would want to increase my risk as much as possible, but not compromise on my peace of mind. That's how I think about investing. You got to figure out your own game and learn about it. Yeah, that's what I have to say. But don't get into what most of the YouTube channels are saying, that you should learn how to pick stocks, learn all of those things. Really, that's all rubbish. Okay, that's about it. I would now want to take up few questions that have been asked by investors in YouTube. So let me quickly go through this. Yeah. So Swapnil is asking, are we compromising on some of the stocks having strong fundamentals, technicals, but not including in portfolio just because their prices are high? I haven't seen any stock with price greater than 2,500. Yeah, Swapnil, I think this is a right question. Because we want to serve the masses and we want to create portfolios with lower ticket size, uh, we have tend to we tend to pick stocks which are not very highly priced in terms of their absolute prices. So overall, this might impact uh, the overall universe that is available to us is slightly smaller. But I'm not sure how big an impact that will have on the overall returns. Whether it will be considerable, I really don't know. I don't think so, by the way, that the impact of it would be considerable. But this is something that I think we should look at it once again. We looked at it when we released our portfolios, but maybe we should go back and check this again, how much of an impact this is having if we are excluding the very high priced stocks in our portfolio. So good question, Swapnil. Thanks for bringing it up, and let's look into it and we'll get back on this specific question. Okay, next question is still the same today. Okay, why Adani Power was not in our portfolio. Again, Pramod, you would not comment on any stock specific uh, question. Is this the correct time to invest more money for averaging? Riju Das is asking. So Riju, my answer is still the same. If you have money, I think it is the right time to invest. It's a good time to invest. Yeah. Again, not counting the market valuations, but that's how one should go about investing. Yeah. And again, considering uh, this money that you're investing is for the long term, it's not for next 1 or 2 years. That is a short term thing. So if the money that you want to invest is just for your short term goals of 1 2 years, then it's better not to invest it into equities. Go with debt funds. But if it is a long term investment, then definitely it's a good time to invest. Yeah, so Sudhanshu is asking, should I couldn't rebalance on third? I'm in loss and Should I rebalance tomorrow? I don't think so, Dhanshu. That's what I have seen overall. Don't wait for too much. I think try to rebalance as soon as possible. If you haven't been able to rebalance yesterday, tomorrow morning, just wait for 15-20 minutes, wait for market to stabilize and have the liquidity, and then you can rebalance. So yeah. Jitendra is asking, I've been around 2 years with Gulaq and the confidence quietly grown into me, quite happy with the progress. Jiten, thanks a lot for keeping the trust. I think 2 years back, 2022 was the time where the markets were not really rising. It was mostly a flattish time. And I think yeah, that's how investing should work. Try to see in whichever, not only in Gulaq, but in all the equity-based investments, try to be invested for a few years, and then the results would become magical, really. Pramod is asking, how are you planning to counter massive uncertainty in the market? Pramod, uh, we have already pushed our rebalance, and the next rebalance would be most likely on 1st of June, sorry, 1st of July. So everything, every market information will be out there, built into the prices, into their fundamentals, and that's when we'll rebalance, taking into account everything. 1 month is not really long in the long-term investing. So that's what we are happening. That's what we'll do. And we don't have any other plan to, yeah, don't have any other plan. That's what we'll do. I rebalanced as in scheduled yesterday. Now I'm in a huge loss. So see, regarding the loss, the market uh, has been volatile. Between yesterday and today, if you count both these days, I think portfolios would be down anywhere between 2 to 4%. Uh, And that is what I said when I was discussing the gear-based methodology, that equity investing by its very nature in the short term is volatile. But when you look at longer term returns and longer term results, it won't seem as risky, right? But if you're really concerned about the movements that are happening in Gear 6 or in maybe other equity funds also, today I think Nifty only fell more than 6%, and small and mid cap fell even more. So I can understand it could be big volatility for many investors to take. And that is why we have been saying that there are other funds, there are other gears like Gulaq Gear 5, Gear 4. You should consider strongly, I would advise you to consider those gears, because in those gears, the volatility is lesser. See, if you are expecting highest returns, the risk also would be higher, right? So, but in gear 4, which is 60% equity, 40% debt, I think it's a very, very solid product. The kind of returns it has generated over last 4 or 5 years is amazing. With the volatility, it's very, very less volatile as compared to gear 6. And that is what I would suggest you. Even in mutual funds, there are hybrid mutual funds, which wouldn't have fallen 5 to 8% what most of the other funds have fallen today. So look at those kind of funds, whether it's Gulaq Gear 4 or 5 or hybrid mutual funds. That's what I would have to say. Yeah. If we have last month you purchased 5 new stocks in which 4 are not performed. Riju, again, this can happen. Not all stocks will be profitable. Not all months will be profitable. The way to judge a portfolio, the way to analyze a portfolio is slightly longer term, over 1 month, 3 months. These are very, very short periods of time. And even last year, I've been saying this, we underperformed for 3, 4 months. Uh, yeah, but even then our returns were phenomenal. I'm not saying this year also it will be phenomenal. Anything could happen, but short term is not how you judge any portfolio. Yeah. What should be my portfolio size in Gulaq G6 for expense ratio to be less than 1%? Please include brokerage charges. So if you want your portfolio expense to be less than 1%, our cost for the year is about 5,800. So that makes the portfolio size to be 5.8 lakhs. So at that value, this is excluding the brokerage. Let's say if you include brokerage and slippages, uh, maybe 5.86, so maybe above 7 or 8 lakhs is where you would get less than 1% as your total expense ratio. So that's the number you are looking at. Again, a ballpark number, but about 8 lakhs. So Rajesh is asking that you have been churning a lot, sometimes buying and selling same stocks over a few months. Holding those stocks could have resulted in higher profit. Yes. In this instance, yes. But over long run, again, what we are doing is rule-based systematic investing, Rajesh, right? So you cannot have one rule for 1 month and then change your rule for next month. You cannot do that. And if you do that, let's say what you're suggesting, maybe if we do that over long run, trust me, the results won't be as good as in this specific methodology that we are currently using in Gear 6. Okay. So you again, you have to look at it over long run. You cannot say that currently in this market, I would use this rule. That will be discretionary investing. That is what maybe other managers are good at, but we are good at rule-based investing. So again, you don't want us to be doing which is not purely systematic and rule-based. That's not we are good at. We are good at this, and that's what we would like to continue doing. Okay, is it okay to partially exit? I don't think so. Again, if it is uh, for your long-term investments, do not consider because these are purely random. Yesterday it was totally different story. Today is totally different. So yeah, that's what I would say. Okay, this is the best time to sip. Sip is, I think, every time, irrespective of market conditions, you should add SIP. And there's a comment regarding a specific stock. Again, I would not like to comment on any specific stock-based uh, change. Okay, then. Uh, Thanks a lot. Thank you for taking out time on this very interesting day. And thanks a lot. Thanks for your trust. And I'll see you next month. Okay.